Okay. Yes, the floor is mine. Okay. So thanks a lot for taking time to join us and learn a little bit or talk, exchange some ideas regarding how COVID-19 shaped 2020 and what is it that we kind of have to come in the future. So I'll start by discussing initially exactly how 2020 was supposed to be, and then what it came out to be. Okay, so that's how we'll start. I'll start by outlining basically how we felt the impact, how 2020 ended up rolling out. Then I'm going to look a little bit at new trends and acceleration of previous trends that were brought by the pandemic on labor markets, consumer markets, and so forth. Then I'm going to make a little bit the point that we do have a crisis, but the crisis, when it hits, it's never the same for everyone. And that everyone can be workers, can be firms, sectors, industries. It's never the same. And we will end by outlining some strategies that can deal with this crisis and actually might help you take advantage of it and thrive instead of just survive. Okay? But of course, let's start with the beginning. And I mean, 2020 is in the past, and now it seems like we got used to this new state of things, wearing masks, all the confinement procedures, sanitary checks, and so forth. And we've been into this for so long now, I think we kind of forgot a little bit how the world was before. So the way I'm going to start this is by showing you what most economists thought 2020 would have been. And these forecasts were made in December of 2019. Okay, so regarding 2020, it was not supposed to be a fantastic year. Okay, Germany was on the brink of going into a technical recession. The eurozone was slowing down. So these were the growth prospects for different world blocks regarding 2020. The world was supposed to grow at about 2.5%. United States a little bit less, around 2. China typically has the strongest growth because, of course, it's one of the poorest. I mean, it's poorer than developed economies, and then of course tends to grow a little bit more, so they had more robust growth, and then the eurozone with some modest growth of 1.5%. Okay, but this was the outline or the outlook in 2019 in December. You fast forward 3 months, March comes, and guess what? Everyone knows that now we have a pandemic. The pandemic is arriving to Spain and Italy. It's becoming widespread in Europe, and all these predictions regarding 2020 were revised, of course. So now, by the end of March, 250 economists that work for Oxford Economics, they thought that the world would be growing at about 2.5%. United States now, sorry, would grow at 0%. So on average, the world as a whole would not grow. The United States would have a small contraction. China, and that was the pandemic, the focus of the pandemic was, reduced the growth prospects from 6% to just 1%. And in the Eurozone, we would have gone from a 1% crisis, 1% growth to a recession of about 2%. This was what 2020 was supposed to be, judging from March. But of course, people were aware that this was a pandemic. There was a lot of uncertainty associated with it. So they drew a worst case scenario. Okay. So in the worst case scenario, the world would actually contract by about a little bit above 1%. United States would actually go down by about 3%. Eurozone a little bit above 3, okay? And China would experience a mild contraction of 1%. Okay, so this was the worst case scenario that was outlined by 250 professional economists in March. Okay? Now we fast forward a couple of months later, and here's the central baseline scenario. We go from a worst case scenario for the Eurozone of close to 3% to a contraction of minus 10%. Okay? This is how bad our predictions were, okay? And of course for the United States, for the world. So all the predictions were being revised for much worse scenarios except for China, okay? Or except for China. Again, we go back forward again to IMF forecasts in October, and now everyone thinks after the summer and the pandemic kind of is down a bit that it would actually end up better than we thought. So the predictions were now United States would go back to a recession of 4.3%. In the Eurozone, the recession would be a little bit milder. For the world as a whole, a little bit of a revision upwards. And for China, growth prospects were expanded. Okay? So forecasts seem to stabilize in October, and actually 2020 relative to the forecast in October ended up being even better than what most economists in October were expecting. Okay, of course they only had 3 months to guess anyway, but the point was that the world was now growing at 3.3%, and these are numbers that were released in April of this year, so they are, confirmed in that sense. So indeed, 2020 ended up being better than the forecasts in July and the forecasts in October, but of course much worse than what economists thought in March. Okay? So the question now is, what's going to happen in 2021? And there's a famous saying by Truman, former US president, that he would like to have an economist as an advisor that would have only one hand. Okay? And the reason for this is that every time you would ask for advice, the economist would say, on one hand this happens, on the other hand that happens, and Truman would never know what to decide. Okay? So to follow a little bit on that tradition, I'm going to tell you a little bit, what we expect the recovery to look like. So of course, we make a lot of mistakes because forecasting economics is never easy. This is a complex system with billion of interacting parts, firms, governments, agents, banks, and so forth. So there's the whole uncertainty about economics. But on top of that, we have all the uncertainty about the pandemic. And if there's any group of people that has made a huge contribution for the reputation of economists, have been epidemiologists, because they never get it right either. Okay, so we're not the worst in the world. I guess people trying to forecast numbers for the pandemic actually are doing a worse job than we do. So in that sense, we have the uncertainty of the pandemic, okay, that of course affects the economy, right? And on the other hand, of course, we also have the uncertainty that has to do with the economy, okay? So on one dimension, what's going to happen in the economy is going to depend on how well our public health response is in containing the pandemic. In one extreme scenario, we would have ended it by after 2 or 3 months, which was not that different from what happened in SARS and 2002. On the worst case scenario, we can't really kind of, solve the public health issue. We have to learn how to live permanently with the virus. You can see how huge is the uncertainty that just the pandemic dimension brings into the forecasting business, into us making guesses of how the world is going to look like in the future. Now, of course, in terms of economics, there's also uncertainty, because on one hand, we can have, design policies that ended up not actually helping much the economy, not preventing job and firm destruction. On the other hand, we make very effective policies that prevent job destruction, prevent firm destruction, and then as soon as the public health response gets stabilized and we have a new status quo, then from the economics dimension, the economy will recover pretty fast. And that kind of gives rise to all that alphabet that you've been hearing. Are we going to have a V-shaped, an inverted W-shaped, an L-shaped, Nike logo-shaped recovery? So all of these things are going to depend essentially on how effective are we in terms of the public health response, and of course, how effective are we from the economics and the pandemic, okay? So in the best case scenario of all, of course, we would have kind of a V-shaped recovery, because as soon as the pandemic side was taken care of, no job destruction, no firm destruction would mean that we open door and everything goes back as usual, okay? We know that we didn't succeed in that. We know that the public health response has been far from what has been done in previous outbreaks. And of course, there's a big uncertainty regarding the degree to which the economic programs that we rolled out were effective in preventing this job destruction and firm destruction, okay? And essentially, that's what's going to shape recovery, okay? So again, if we have to deal with the virus in a more prolonged way, of course, even the most effective of economic policies won't prevent businesses from staying closed because of containment measures, and then the economy stays depressed for a long time, okay? At the same time, even if we're not very good at preventing the economic fallout from this crisis, even if we would have had a very strong and effective health response, the economy would also show a little bit of a sluggish recovery. Okay, and of course, the worst case scenario is one where the vaccine wouldn't have shown that we would have to learn how to live in a pandemic situation for a much more prolonged period, and we were not able to avoid job destruction and from destruction, and then of course there would be a permanent loss in economic activity. So today we don't believe that's the case. I mean, there's an initial recovery that it's a bit V-shaped that has to do with the end of the need to stay confined, and then we have following that what we predict now, the central base scenario is a recovery after that initial V-shaped, a recovery that's going to be a little bit prolonged in time because we know that we have huge increases in unemployment. We're going to see how the economy is going to react when we start kind of phasing out all the credit lines, deferment of payments, and so forth. So I would say that somewhere around here is the base scenario with the slope of the recovery after the initial V-shape part to be determined mainly by the next numbers on bankruptcies and unemployment. Okay. This being said, there's a lot of discussion about whether confinement actually kills the economy. So there's the question to be done, which is there really a trade-off between economics and health in this sense? Now, in a static sense, that it's obvious. If we prevent economic activity from happening today, it's obvious that economic-wise, we're going to be worse off today. There's no question about that. Now, the issue is the world is dynamic. So there might be the possibility that by confining the economy today, we're actually saving the economy tomorrow. Okay? So there's a paper by Sergio Correia, Stefan Luck, and Emil Werner, which is this one that I'm showing you here. And what they did was to look at the 1918 pandemic, okay, the Spanish flu, and they looked at how different US cities dealt with the pandemic in terms of confinement. Okay? And they also looked at how they performed economically in the years that followed. And what they found was actually that the cities that were more aggressive in fighting the pandemic, which are the ones in green, we had the strongest confinement measures, were actually the cities that afterwards, in the 4 years that followed, ended up growing the most. Okay? Now, does this mean that it's a clear-cut and obvious answer that we should confine to get the pandemic completely under control and that will help the economy in the future? Well, first of all, the world in 2020 is very different from the world in 1918. So that's one thing. The second thing is, this is not a static question again, okay? Because the kind of trade-offs involved in March last year, where they had very little information about how to deal with the disease, we had very little information about a million other things, okay? It's very different from today, where we have some treatments, we have a vaccine coming. So not only the right answer to this is dynamic in time, the answer would be very different. The answer to what is the trade-off between economics and health in the short run and in the medium run. The answer would be very different in March than it is today. Today the economy has adapted. It's not by chance that if you look at numbers from Bank of Portugal, for example, for the Portuguese economy, that the reduction in economic activity in the second confinement that we had last month was about 40% less severe in terms of economic impacts than it was the confinement last year. And this happens because people and firms and workers adjusted to the new state of things. Okay, so the same confinement doesn't hurt the economy as much. So you see why is it so hard to provide to a definite answer to this question. But at least it's worth having it in the back of your mind and not having an absolute position that says, well, if we confine, we kill the economy. That's not obvious. Okay, actually the right trade-off is up for grabs and changes with time. Okay, so after this initial introduction, of course, you'll ask me, what about 2021? What will it bring? And I don't know if you still want to ask me this after I showed you the forecast of professional economists, but if you're brave and naive enough to ask an economist how the future is going to look like, well, stay sit and let's look at it. So looking at the IMF, the forecast they did for 2021 and 2022 for these different blocks, in the US, 2021 was supposed to be a year with a strong recovery, 6.4%. These are forecasts from April, this month. So these are the most update that we have. And for 2022, a slowdown, of course, from 6.4. A lot of it has to be the regression towards the mean, right? The economy was strongly confined, then it goes back pretty fast, and then of course it can't sustain a growth like that continuously. So it's only natural that after this initial strong recovery, that the economies kind of slow down. Now, notice that in the US, the predicted growth is much larger than the Eurozone. And this is, so it's much more focused in 21 than it is in 22. Okay, 2022. And why is that? Because the US of the developed economies was the economy that by far spent the most supporting directly the economy. Okay, they spent around 19% of GDP, 12% under Trump, and now with the new Biden plan, it went up to 19% of GDP. So of course the economy will rebound faster, but of course there will be costs involved. There's the danger of inflation that I don't think it's very strong in Europe, because the fiscal response, the state aid to the crisis was not as strong as in the US, but still, that's up for grabs. China here shows also robust growth. That's historically it. And if you take into account the whole world in terms of the world economy, we see again a robust growth in 2021, and then albeit smaller growth in 2022. Okay, so understanding a little bit the macro context and the dynamics and what to expect or not, now we're going to look at some new trends that COVID brought and how that affects labor markets and consumer behavior. Okay, so we're going to start by enumerating a couple of naturally obvious facts that we've been looking. One is that, you know, with all the when we produce goods, we know that, you know, each component of everything that we produce comes from a different place, right? So there's a lot of risk in terms of supply chain. And one thing that we noticed was that right in February, we saw, when the COVID was mainly a Chinese issue, we saw that were firms in Europe that stopped working. Okay, there's a Portuguese company in the north, for example. They had very little exposure to China. They exported to China about 3% of everything they produced, and they imported from China about 1% of all the intermediate goods that they needed to produce their stuff. But guess what? They had to close. And why is that? Because the intermediate inputs that they used, that they bought in Switzerland and in Germany, the German and the Swiss producers, they were buying their raw materials from China. Okay, so remember that there's a global value chain that is completely kind of all over the place, and it's very hard to really understand all the risks that are involved in terms of your supply chain. So, of course, in that sense, local suppliers will gain strategic importance. But let us not fool ourselves. There's a reason why we were buying stuff from China. And the reason why we bought stuff from China was because it's cheaper. So if we want to diversify the supply chain and we want to buy stuff locally, of course, that will come at a cost. Okay, that will come at a cost. And you're going to have to pay more. So costs are bound to increase in that sense. But remember that this kind of supply chain disruption dynamics is not something that COVID brought out of the bat. I mean, all the trade wars and the Trump with Canada, with the Eurozone, with China, with Mexico, I mean, all of that was already one of the key factors that launched a lot of uncertainty on trade relations. And it's not by chance that the Next Gen program from the EU, one of the pillars is precisely reindustrialization. Okay, they want to, you know, bring back industrial production back to Europe. I'm a bit skeptical about that. Again, for the reasons that I told you, there's a reason why we offshore production is because it's cheaper. And the only way that you can be competitive if you bring that production to Europe is one of two things. Either you start charging duty taxes to allow European companies to be competitive, which is basically, you know, counteract competition, which we know kind of hurts productivity growth and so forth. Or, okay, we need to subsidize these companies to work, and so they can be competitive. We need to subsidize production. And again, subsidizing production will make it also, it's going to be subsidized with taxes, and the taxpayer will end up paying the higher cost anyway. So I'm a bit skeptical about this. People were being very apocalyptic about what would happen to growth, to trade, sorry. And guess what? Trade is back as it was today. 1 year after, COVID didn't really disrupt trade. So I'm a bit more skeptical on this, but everyone is kind of, singing this song. Anyway, what hasn't changed, and is here to stay, is that online became the new normal, okay? Even the most resistant of people who hate going online to take care of their bank accounts or whatever, they were forced to do it because there was no other way, okay? And once you learn it, once you become comfortable with it, okay, people are naturally resistant to change. But once you learn how to do it, once you were obliged to change, guess what? You can't unlearn it. You can't forget everything that you learned. Now people are quickly finding out that that trip to Basel or Frankfurt can be easily sorted out with a Zoom, as we are doing today, okay? So in that sense, that is here to stay. And this will lead to increased competition. Because if you start buying online, it's much easier to compare prices across different sales platforms, okay, than it is going to, a store, a physical store, and then going to another physical store, and then going to another physical store, and so forth. And this is also true not just for shopping around, but also for labor relations, okay? With all the development of these remote work platforms, it's much easier for some type of work to be, done with remote work. Now we're probably going to see people in Portugal, in some natural landscape in Algarve or Alentejo, working for a German consultancy firm because all they need is a laptop and a headset and a good internet connection. So there's a new world coming with increased competition where competences are determinant to stay relevant. Okay. So next, of course, new sanitary standards are likely to persist in the future. I guess everyone now understands, the danger. I mean, what one person eating a half-baked bat can do in terms of the damage that it generates in the world economy, and so forth. There will be much stricter, and there are in place already, much stricter sanitary procedures. Okay, but of course, again, sanitary procedures in terms of trades of goods, services. Well, not so much services, but goods and people. This means that there are extra costs that again will revert to firms and households. And of course, if there's extra costs, we'll create even more incentives to defer business travel, to defer a lot of things that have to incur in these costs. Okay. Another thing that we tend to see also is this increase in social pressure against para-health movements, right? Anti-vaccination and so forth. These people, of course, now are having a much stronger backlash, both from authorities and from the general public, because it was made bluntly obvious what is the potential impact of a pandemic and a disease outbreak. Welfare state becomes central. So here's the issue: private markets are very good at diversifying idiosyncratic risk. What do I mean by this? If I need my car to go to work, and I'll starve if I don't have a car to work and gain money, it's very smart for me to buy insurance, because if something happens to the car, right, the company pays me back so I can buy a new car or fix mine, right? And the private firm's business, the private insurer business model, is to bring sufficient number of people into the pool and then apply the law of large numbers. So instead of me having to have, 2,000 euros on the side, just in case, I just pay a small share of that, okay? And then I'm protected. And that money can be used to, spur the economy and my personal businesses, okay? But guess what? If everyone hits with a car at the same time, there's no private insurance that will help you. And this is what happened. A lot of people were surprised that many health plans didn't cover pandemics. The same way that they don't cover earthquakes, they don't cover, this kind of natural disasters. And that's because private insurance doesn't work when everyone is hit at the same time, when there's systematic risk. Okay, you can't use private insurance or to diversify systemic risk. Okay, so that's when the governments have to step in. And the government intervention has been perceived as especially strong and useful during the Great Recession and the sovereign debt crisis. And that created a landscape for the much stronger fiscal activism and intervention that you saw in the context of this crisis. I can't even imagine what would have happened in the US politics if someone would have said that I'm going to spend 19% of GDP stimulating the economy. This would have been unthinkable like 12, 15 years ago. Okay? So there's that. And of course, I mean, this crisis doesn't hit everyone the same way. So there's been a huge increase in inequality, both between countries and within countries. Okay? Within countries, because the pandemic in itself doesn't affect everyone the same way. We know that, COVID is much more dangerous in people who have comorbidities, like diabetes, obesity, high blood pressure, and all these pathologies are more prevalent in the poorer segments of society. Okay, that's on one hand. On the other hand, there's also the part of the work substitution. So people who actually can perform their duties online, they don't get as affected as the people who have to engage in manual labor and that involve physical proximity. Okay, and people in these sectors, in some of these sectors, have been suffering huge losses of income. Okay, because they're being prevented from work from the confinement measures. So in that sense, this crisis has been very unequal. And then of course between countries too, because poorer countries rely more on the second type of work that I just described. Okay, they are less service-based economies. They are more industrial-based or agriculture-based economies, poorer countries, and they tend to be hurt the most. Okay, and you can see that the COVID recession is completely different from the previous ones. Here we have the 1990s recession in the US, 2001, 2008, even the Great Recession 2008 looks like a kid's play if you compare it with the coronavirus crisis. Okay, and again, as I mentioned, there's a high degree of heterogeneity. Just compare how the top 25% in terms of employment suffered. They are now above pre-crisis levels with the people in the bottom of the income distribution who had losses in employment of more than 20%, peaking at more than 30%. Okay. Okay. Impacts on the labor market. So what do we see? Well, first, for the first time in history, physical proximity is now a factor in terms of differentiation of impacts of economic activity. Okay. What we see is that there is also a large disparity in terms of physical proximity across occupations. So it became important, and there's a high degree of it. Okay, it became a major factor. The kind of physical proximity that is involved in transportation of goods or outdoor production and maintenance is very different for medical care or personal care. Okay, and this has become a factor. Okay, a main factor in these dynamics. Then the second thing is what COVID brought is a huge acceleration in technology adoption. For example, e-commerce. E-commerce had been experiencing a steady growth every year as a share of total retail sales. For example, in the UK was growing at about 1.3% a year between 2015 and 2019. 2020 it grew 5.7%, about 4.5 times more. Okay, so if anything, what the pandemic brought was a huge acceleration in these technologies adoption. Okay, which makes the speed at which people are getting, occupations are getting obsolete much faster. Okay, much faster. And here we see the expected growth rates in occupations, okay, occupational categories across time and across countries. And what we see is a consistent, for most countries, decrease of employment shares in customer service and sales. So now we have a lot of artificial intelligence, online platforms and so forth providing these services. Okay, food services, agriculture, production and warehousing, office support, all these things are things that are getting, substituted every day by artificial intelligence, machine learning, digitalization, automation of procedures, and COVID brought a huge acceleration. So what kind of employment is being actually created? Well, all the types of jobs that on one hand, they don't rely so much on physical proximity, but also that are essentially creative and rely on cognitive tasks, okay? And that's why we see, for example, science, technology, engineering, and math professionals growing everywhere, health professionals, obviously, more creative kind of positions like managers, and tasks that even though they might have a low cognitive weight, they cannot be at least not in the short run, they cannot be performed by machines or any sort of automated procedure, which is, for example, taking care of the elderly, health aides and so forth, care workers, and these are kind of occupations that cannot be substituted by technology, okay? These are the ones that are growing over time and where we also see wage increases. So if you want to plan ahead and think about what kind of professions you want to follow and what the sectors you want to be moving into, these typically are the sectors that are growing and these are the sectors that are shrinking, okay? At least in terms of employment shares. And this means that COVID was kind of something, as I said, that accelerated this digital transition. And this is the degree to which it did for different countries, okay? And for example, for the US, pre-COVID, the need for people to transit to new occupations by 2030 was about 7.9% of every job. Now it's around 10. So there's like a 2.2 increase just from the COVID, okay? So again, COVID brought a huge acceleration to digital adoption and the need to reskilling, upskilling, and so forth. Consumer demand recovery and the lasting effects of COVID-19. So let's look at that. So in terms of consumption, it was huge, right? I mean, look at the drops of consumption in China, France, Germany, United Kingdom, and the United States compared with the Great Recession in 2007, 2009. The Great Recession all of a sudden doesn't look so great anymore, right? So at the end of the day, the two key factors here, or the two key messages I want to pass with this slide is that first, COVID was much, much, much deeper and strong than it was the Great Recession. And we reached the bottom much faster. So in the Great Recession for France, it took about 5 quarters. Okay? For COVID, it was just 2. Germany, 8, 2. UK, 5, and US, 6. And again, just 2 quarters to go from pre-crisis to the bottom, okay, to the most severe point of the recession with COVID. But there's a second salient feature I wanna bring up, and that second one has to do with the disproportionate impact on services. You see, the consumption of goods decreased from -2 to -6 from the Great Recession to COVID in the UK, but in terms of services, it went from -4 to -19. So services were the ones who were very, very hit during COVID. For the US, there's not even a significant dip in services in the Great Recession, but it was a 10% contraction during COVID. And that's, of course, because of confinement, not just the legal one where government enforces business closure, but also because people are afraid. They want to get sick, so they don't use certain services where physical proximity might be a factor. Okay, in terms of savings and consumption, we saw that consumption dropped a lot, but a lot of it wasn't because falls in income. A lot of it was because they could not consume. Cinemas were closed, restaurants were closed, and so forth. This means that there was a lot of income that many households managed to generate by remote work and so forth that they did not spend. So correspondingly, the savings rate increased like crazy, okay? It was unprecedented. For the recorded history in the US, there's been like no record of a savings rate of about 26% as it was in Q2 of disposable income. So this makes a lot of people start thinking about revenge consumption. So now that economies are kind of opening up in terms of confinement, what's going to happen? Are people going to be spending money like crazy? In which kind of goods? So everyone is looking out for opportunities to capitalize on this extra savings that households have and try to cater to their preferences. And okay. And it's also important that when we think about sectors that have been growing, that there's a huge degree of heterogeneity across countries. So for example, look at e-commerce, okay? So here, this blue dot tells us what's the average score in terms of the change in consumer habits becoming permanent, okay, across all those countries that I showed you before. But the issue here is that there's a huge degree of heterogeneity. And this has to do, for example, with the fact that even before the pandemic, in France, for example, there was already a large presence of e-grocery services, okay? And people already, it didn't have a very large market share, but it was something that, you know, a good degree of the population knew. There was the infrastructure and firms were prepared to do home delivery, okay? And having people buying online groceries. But for example, for Portugal, that's not my prior. My prior was that for Portugal, a lot of people tried to buy stuff online. They got the stuff like 1 month later, right? Clearly, we didn't have infrastructure. So that will, of course, determine how people view those services, okay? So as soon as the economy is kind of ease out, the good experience, the good customer experience that people had with some services will determine the adoption of these services in the future, okay? And this is what explains typically the heterogeneity across countries, even though, of course, everyone believes that it will gain market share, okay? But again, it will gain more market share in some countries than others. And this is true, again, across all elements. Okay, so the last 2 points. First, as I said, the effects of the crisis are very, very heterogeneous. And when the crisis comes, it doesn't hit everyone the same way, okay? So if you look at the past recessions in the US, in every single recession, okay, there are always companies that manage to increase both margins and volume of sales. Of course, the majority of it, the ones here in red, they will experience a decline. And that's why it's a recession. If the majority experience an expansion, then it's not a recession, it's an expansion. So the majority of firms in recession go, you know, lose market share and or volume. That's why it's a recession. But the point I want to make is that there's always firms across sectors and within sectors that manage to see opportunities in crisis to grow, both in volume and in margins, okay? And this is true for the past recessions, but it's also true for this one. So what you have here is market capitalization for many, many different sectors, okay? And what I want to show you, and this is the salient feature of this plot, is that there's huge degree of variance. This interval contains 75% of all observations of market capitalization in a given sector. And you see that there's a huge difference between the worst, the 25th, the 75th worst firm or the 25th best, okay? There's a very big difference. And there are strategies that you can put into place to be here instead of being here, okay? And we're going to talk about those just in a second. In terms of the stock market, again, this is February. Okay? Oh, this is March, actually. This is March 23rd. And what we saw was that relative to 1 month before, February 19, all sectors were kind of, the average per sector, were actually down, right? Everyone was experiencing a crisis. But you fast forward a couple of months and you start seeing that some companies are emerging and there starts to be a large degree of differentiation among sectors. Again, another quarter ahead, and what you start seeing is that these differences that started to emerge are being amplified. And this is the structural impact of COVID. 1 year forward, we clearly see who are the winners and what the market expects will be profitable businesses and sectors in the future versus the ones that are where there is structural and lasting impact of COVID. Okay? Okay, and last, to finish, because we're almost at the time, I want to talk you to a little bit about how strategies that helped you becoming one of the top performers versus being on the bottom, okay? So for all this, I outlined here 6 dimensions for which you should look after in your company. And for each one of them, what you need to do is create scenarios and test the resilience of your firm to these different scenarios. And that's how you get a clear view of how in shape your firm is, not just to survive COVID, but also to thrive in it. So in terms of demand, consumer, your client behavior, it's important to intensify communication with customers, starting from large to small. Okay, this is a huge moment of disruption where consumer loyalty is being put to a test. It's much easier to change suppliers, to change people who we buy stuff from in moments of great disruption. And why? Because disruption becomes normal during these times. So consumer loyalty becomes much more tested in these times. So it's important that you are very close to your clients and you understand what they want, what they need, and if you are getting it right. Pay also attention to market trends and adjust production, marketing, pricing to adapt to changes in consumer behavior. Some restaurants developed home delivery. Okay, and now, even though we're opening, they found that it's a good business model that brings them extra revenue. So they will keep having that channel. Okay, they didn't stop doing home delivery. And this is true not just for the restaurant business, for many other businesses. There are industries which are going through huge disruptions. So for example, in the pharmaceutical industry, we just found that, the delegates that used to go to hospitals, talk to doctors, and so forth, the industry thinks that they're not that useful anymore. So they're being, laid off a lot. And now primary contacts with the medical doctors and hospitals are being made by digital platforms. Okay? Because remember, even though we needed digital platforms to deal with confinement measures, all that increase in technology and availability of solutions brought much more advantages, brought many more possibilities of these remote work platforms. Okay? And these are not going to go away. Okay? So, for example, these delegates in the pharmaceutical industry are some of the victims of this process. So pay attention to market trends. If you are in the business-to-business segment, it's a little bit harder for you to anticipate, how the market in the final goods is affecting you, but try to talk with your clients to understand, what's the behavior of the clients they ended up selling their products to. And again, explore alternative sales channels. Online, home delivery. I remember I teach executive education a lot, and before COVID, I used to talk with some executives that would tell me that, having an online channel, it's nice, it helps the brand, and so forth, but what I really make money is in the stores, okay, in the physical stores. I don't think they think that anymore, so that's something to have in mind. In terms of supply, you have to identify risks along your supply chain. Okay, I told you the case of that firm in the north of Portugal. I could give you 10, 20, 50, 100 other cases where, you have disruption in the supply chain and that prevented you from operate. Okay, so you have to identify these risks, have a notion of which ones are more important, either because, they're more important in terms of the impact on your ability to produce, or because they represent a larger share of your value creation, but you need to identify these things. And then you need to identify alternative suppliers for these critical inputs, okay? One way of ensuring against disruption into the supply chain is inventories. So if you're in some business where scaling up inventories is a possibility, makes sense in your business, then you have to evaluate the costs of it and whether it makes sense to use that as insurance to supply chain disruptions. Even, either as intermediate goods, to store intermediate goods, or to store produced goods that are just waiting to be sold. Okay, and again, as I mentioned, disruptive times test consumer loyalty a lot, so keep clients in the loop to make sure you don't have reputational damages. In terms of safety, obviously you have to protect client, workers, and suppliers and ensure a steady supply of protection equipment, and operate, according to the recommendations of the health authorities, not because we're nice people and it's the right thing to do, but also because the last thing that you need is some court suit because, one of your workers was working in unsafe conditions and is going to sue you and put you in court, okay? So you don't want to have those kind of liabilities around. So it's the right thing to do and it's the smart thing to do. And keep, of course, monitoring these operating procedures because they are bound to change over time. If you can put people, in remote work during these periods of until the vaccine program is completely rolled out, that's one of the smart things to do. And one thing that people tend not to look out much is, it's paramount is to protect confidential information. All of a sudden, we have people accessing vital company information remotely because they are at home, accessing online, accessing remotely information from the company. These are huge security risks. So you should have this into account. In terms of politics and policies, it's important to follow closely which policy measures are being proposed and speak up with your industry's associations because they are the ones who tend to do some lobbying with the government to make sure that policies reflect the needs of specific industries, okay? Also, it's always the case that any government program is typically designed to help companies that are in legal and fiscal compliance. Okay, so it's always that's a way of creating incentives for firms to be on time on taxes and social security payments. So make sure that's the case to the best of your possibilities because a lot of the help can be dependent on that. Okay, also producing financial statements and reports, information that shows the help provider that your company can benefit from that help is paramount and can be the difference between getting help in 1 month or 3 months. Okay, in terms of human resources, flexibilize. I mean, this is a new world. There are not many books written about how to organize work relations in COVID scenario. Okay, so keep it flexible. You have no idea if one of your workers is at home and they have small kids climbing up the curtains and screaming. I mean, try to flexibilize the most. Roll out remote work programs. But there's a word missing there. Roll out remote work teaching tools. Nobody was born knowing how to work with Teams or Zoom or whatever. So that's important for them to be able to bring value added. And talk a lot with your collaborators because they are the ones experiencing these processes and they can help build the new normal. And lastly, but of course one of the most important, has to do with finances. Disruptions in cash flow were the norm. It's not by chance that one of the biggest programs that governments followed was precisely credit lines, deferrals in payments for fiscal responsibilities and social security, because of course if you are closed, people stop buying, consumption goes down, naturally you're going to have a huge cash flow shock, okay? And the last thing that we want is a firm who has a viable business model, who produces a good or a service that is valued by consumers, having to close and fire people because of liquidity issues, okay? So liquidity is the number one priority. You should stress test your liquidity needs so you can have a sense of the degree of help that you might need. Of course, it's not a very politically correct thing to say, but you know, if you have a deep drop in your demand, letting go temporary workers is the most obvious and painless way from a financial perspective. Also, start talking with your financial partners to extend maturity on your loans and to explore liquidity options, okay? Credit lines and so forth. And worst case scenario, if this is the difference between closing or remaining open, think about factoring. Okay, if you have some debts that you can't collect, maybe that's and selling them to a third party is the difference between you staying open or closing, then there's not really an option and you have to go through it. And remember, all these changes to make the supply chain more robust and so forth, they will bring added costs. Okay, and you need to factor them in. And remember, you know, even in crisis, there are always companies that manage to thrive and become better. So here I give you an example of an orthodontic clinic that noticed quite rightly that now is the right time to wear braces because nobody's looking. Okay, so I hope that you enjoyed this little moment. I hope I didn't stretch myself too much, and I don't know if there are any questions from the audience. If there are, I'm more than happy to answer them.
Thanks, Pedro. Fantastic. I think we're going to open for Q&A while you guys think if you have any questions. I think the final message here is that's clear. The world has changed, and 2020 was a tough year. I think despite of our hopes, 2021 is still very tricky and still very challenging. And we invited Pedro not only because he has this cool presentation mode, but also is an expert in the economic scenario and has
Okay, so it seems that there are no questions. Yes, João, that's the whole point.
You can write. You can write in the chat.
Okay.
Not sure if it's possible to unmute João and then,
For me, it's okay. I mean,
yeah, and let João maybe either.
Okay, this way is easier.
yeah.
Good afternoon, thank you. I have a question about how in the future we can see that the remote work will be growing, like you mentioned. And so my question is, how can Portugal, for example, or countries like Portugal with good weather, safety, low prices, in relative to countries, how can Portugal take advantage of this, and how can it attract people from outside to come to Portugal and work remotely from here?
Okay, so thanks a lot, João. So remember that when I talked that there are some segments for which COVID was a structural negative shock. I was talking about business travel, for example, right? So all of a sudden, a lot of people are realizing that that trip to Frankfurt could have been a Zoom meeting, right? And you don't want to queue and go to aeroporto to the airport and queue on waiting for the airplane and all of that stuff when you can just have a Zoom meeting. So COVID brought the increase in technology that made this possible. But there is no technology to go spend your vacations in Algarve with a webcam, right? So it's not really the same thing. So on the tourism side, I'm more worried about the industry, for example, being able to survive the liquidity crisis, because it's an industry that is very leveraged, because they spend a lot of money at the setup, building infrastructures, machinery, and so forth. And they have huge costs of capital that are not being, that they are incurring every period without any income getting in. So on those sectors, I'm not so worried. I think that advantage from Portugal will keep being, it will keep existing. I'm more worried, for example, in some kind of services that now can be provided by someone in India. Okay, so a typical case in the old days would be that you have medical doctors, recording some consultations and sending the voice recordings to India. We're talking about UK medical doctors that would do this in English. They would send those recordings to India, and some guy in India, by very low wage, would transcript them into the computer and would send them back. Okay, so this is a classic example of offshoring, even this type of work. What we saw with COVID is that this can grow to other segments that traditionally hadn't been penetrating much, like consultancy and other kind of technical jobs. So that's a threat. And that's a threat because Portugal, even though we have, it's a threat and opportunity, because within the European Union, that's an opportunity because we have a comparatively lower labor costs, right? But, in comparison with other blocks in the planet, then of course we are at a disadvantage. Portugal has some structural problems that make it not so much competitive. And we could make 10 webinars just on that, okay? But for example, one of them, you see that throughout the 80s up to today, a lot of countries in the West have lowered a lot, for example, taxes on the corporate income tax. Portugal, which used to have a comparatively lower corporate income tax, 20 years ago, today doesn't have a corporate income tax that is very different. But it lost a lot of tax competitiveness, okay? Because before it used to be one of the lowest, now it's one of the highest. And especially on personal income tax, right? So we already pay low wages. We charge really high taxes compared to other countries in Europe on income, for example, okay? So there are some problems. We have a huge number of problems in terms of, for example, collecting, right? You have a company, you sell a product, then you want your client to pay you. And a big issue is that Portugal is by far the worst country in Europe in terms of being able to collect from your clients, okay? By far. We are like twice as bad as Greece which is even really bad. So you see, so this can be a huge problem, especially in recessions, because we have a production system, or we have a private enterprise population that is composed of small companies, okay, disproportionately relative to other countries. This means that they don't have much liquidity, which means that when a recession hits and people stop paying and you can't collect, right, you don't really have a strong position to survive. And then there's, you know, chains of bankruptcies and unemployment, and there's a lot of organizational capital and business capital that is destroyed from a bankruptcy, right? It's never a good outcome. So that's another thing. I mean, we have so many. Out of the 28 countries, or 27 now without the UK, Portugal is the country with the highest share of workers from 25 to 65 that have the 9th grade or less. You see? So, I mean, we can make a whole seminar series just talking about the factors that make Portugal less competitive in Europe. And there's a reason why we joined the EU. Countries from the Eastern Bloc joined after us, and they are all passing Portugal in terms of income per capita. Now, I mean, yeah. So COVID is gonna in many dimensions is gonna make it worse because it will increase competition, right? It will increase competition. So we'll see. So the next is by Eunice Bendella. Do you think a quick recovery of the economy is possible? Well, I think there are two modes of recovery. There's the initial recovery that comes from ending the confinement procedure and people gaining confidence in being able to, in using some services and goods. Okay, so the vaccination is going to be very important to that. And that tends to be very quick, right? Very quick. So it's the so-called V part of the recovery. But then there's a second part of the recovery. And the second part of the recovery has to do with the degree of job and firm destruction. Because if a lot of jobs are terminated and a lot of firms close, there will take some time until new companies open, new people are hired, these people start being productive in the business that they start working, right? And this will make it much slower, the recovery. Now, so far, we don't really have a notion of how it's going to be because their huge liquidity was injected in the system. But for example, Portugal bet a lot in payment deferrals, in loaning money or letting companies pay their taxes later, okay? But they didn't help much in terms of direct aid to companies or even households to deal with COVID impacts. What does this mean? If you look at Germany, for example, they spent around 8.6% of GDP helping, with direct help to companies and people. And they could do it because this is typically forbidden by European law, right? By the Rome Treaty, is state aid, and you can't really do that. But all these regulations are suspended because of the pandemic. So Germany grabbed a chance to really help their productive side. Portugal didn't. Portugal bet on, a lot of credit lines and payment deferrals, which means that you're just pushing the problem forward. Now, you solve the problem of liquidity because you're giving it a lot of liquidity, but you don't solve the problem of viability. Why? Think about the hotel. Even though it's not being able to operate and they can get money to pay the banks, and well, the banks do have credit moratorium, so they didn't have to pay the banks. But the issue is all these months that the bank didn't operate and the capital costs just keep adding. So when they go back to operating, their firm lost a lot of value, okay? And you can even run the risk of starting to find some companies who don't have much capital but have huge debts because they incurred a lot of costs and no revenue through all this time, closing and opening one next door, okay? Generating a chain, again, of bankruptcies and credit losses and so forth. So not to mention that, of course, when everything goes back to normal and Portuguese firms will have to compete with German firms, right? German firms will be in much better position to be competitive because they will have lower destruction of value because they got these state aids, okay? So, yeah, I'm sorry if I'm not more optimistic, but we'll see what happens. looking at all the money. So Mark Carvalho has another question. Looking at all the money governments have injected in the economy, how do you see inflation evolving in the next decade? How sharp can be inflation? Is there a likelihood of stagflation coming from the economies such as the US and the trillions they injected? How does that will impact the EU and Portugal in particular? Okay, thanks, Mark. That's an excellent question. It's a very hot debate right now. Okay, so a lot of people really worried about inflation, and the reason is simple, right? So if government starts spending a lot, okay, and the economy is not being able to produce, what happens because of firm destruction, because of lack of confidence on behalf of people in terms of experiencing those products, whatever, or confinement measures in terms of being able to operate, what's going to happen is that you're going to have a lot more money circulating, putting pressure on goods prices. So it's a game of how much should we do, right? Because you have an output gap, which typically is the distance that the economy is from its productive potential. And the risk is that the fiscal expenditure will more than compensate the gap, because if more than compensates the gap, it will generate inflation, okay? Now for the US, it's a big thing, because the aid during Trump was about 12% of GDP, is getting to 19% of GDP with Biden, okay? And I don't think anyone thinks that the output gap in the US is very close to those values. Of course, it will rely on one key statistic, which is the fiscal multiplier, meaning that if the government spends $1 more, okay, how many more dollars of economic activity will it increase, okay? And even for reasonable values of fiscal multipliers, people think that the US economy can overheat, okay? And if that happens, it's a problem, okay? In Europe, I'm not so worried because, well, first of all, the fiscal response is not even comparable with what they did in the US. Okay, Germany was one of the countries that spent the most, and we're talking about 8.5% of GDP. Countries like Portugal was 2.6, okay? France, I think about 5 or 6. So it's a lot less. And if you look at the output gap, I mean, Portugal contracted at 7 point something, right? You have a lot of countries where, it's clear that the recession, it's higher than it is, the output gap, if you want, is larger than the fiscal injection. So you would have to have fiscal multipliers of 2 or 3 to make the economy overheat above potential output and creating inflation. So again, to make it short, I'm not that worried about Europe. I'm not that worried about Portugal either. I think that it's much more likely that it may be a problem in the US. So Carolina is asking, how do you think companies in general are reacting recruitment-wise? Do you think they are mostly keeping their hiring plans, or are they cutting on recruitment? What's the hardest thing for an economist to say? And you never hear them saying, is I don't know. I'm not a specialist on hiring. I know some trends in terms of what I showed you, but don't take my word for gospel in terms of what companies are doing hiring. What I see is occupational change. So if what you're thinking is in terms of, before I was going to hire some medical delegates to go to hospitals and convince medical doctors to prescribe this medicine, well, they're no longer doing that. Not only they're not hiring, they are laying off the ones that they have. Okay, so in terms of some occupations becoming obsolete, yeah, that's a big shift in recruiting. Technical digital adoption, yeah, that's a big push by COVID. So to the degree that by hiring plans, you are referring to which kind of occupations am I going to hire in the next years, clearly there's an obvious impact. You're hiring more people in IT, you're hiring more people in occupations that are more relevant for the increased digitalized world. And you're much less prone to hire people that became obsolete with this digitalization. And this is something that it's not new with COVID. This has to do with skill or I don't know if it's skill, it's task bias technological change. What is this task bias technological change? Go back to the 70s or even the 80s. When I was like 10, my mother bought me a computer that cost at the time 3,000 euros. He had 16 colors, 20 megabytes of a hard drive, and it had 512 kbytes of RAM. Okay. Today I just ordered a computer for my research group with 256 gigabytes of RAM, and it costs about the same. What do I mean by this? What I mean is that over time, okay, capital goods, especially in ICT, information and communication technology, have become cheaper relative to consumption goods. Okay? So if you had to, so how many toasters is a laptop worth today? And how many toasters was a laptop worth in the 80s? Okay? A lot less today, right? A lot less. So the point is that this technology that is making these ICT goods cheaper, what are they doing? What they're doing is they are increasing the demand of people who work with these ICT goods, right? Because now they are cheaper, they are more used in production, and if they are more used in production, you're going to need people to operate with them. So the demand for IT, I mean, think about it. 20 years ago, there was no such thing as a job description of social networks digital expert, okay? Today there is, okay? But at the same time, occupations that are now being substituted by machines, right? The demand for those people is going down. So you go to McDonald's today and you have a touch screen where you choose the burger. Now you need a lot less employees at McDonald's. Or think about how when I was a kid, well, when I was like 18, I mean, everybody just had, every single gas station had a guy putting gas on your car. Today, it's not that easy to find a gas station where it's not you putting the, putting the ATM card, typing the digits and filling it up yourself. So this has been there since the 70s. What COVID did was to put it on steroids, okay? Digital adoption much faster. So in that sense, relative to pre-COVID, hiring plans are going to reflect this. Okay, Marcus Graf is asking, do you think every country would have been better in the fight against COVID without the EU? Like, do you think the central organization of the EU is holding back countries for making own decisions and so forth, adapting to the situation more quickly? I mean, if there's one event that asks for coordination, I would say that it's the pandemic. Of course, you can counter and tell me, okay, but look at the UK, right? Look at the UK in terms of rolling out the vaccine program. I would say that the vaccine program goes down probably in the history of bad decisions, and it will end up in the Guinness record book. I mean, the European Union, to save a couple of millions of euros, bargaining for much, cheaper prices and more flexible contracts, at the end of the day, saved those millions, but lost trillions in economic activity by the delay that negotiation led in terms of bargaining power within the contract. The UK paid more, but their contract was more ironclad, right? And if you're a pharmaceutical and you have a client that has more legal power to enforce you to do what you promised, and at the same time is paying you more money, where do you think the vaccines will go? So I know that there's a lot of skepticism about the ability of the EU to bring value added, for example, in situations like this. And they are questioning it based on the vaccine program example. I would be careful, not to take the whole for the part. I think the vaccine was a very bad example. And I don't think it characterizes the potential the EU has in promoting welfare and making a better world, as opposed to a world where everyone is apart and they don't have coordinated action. And this happens because, you have two extremes that work, right? Complete autarky. And then, of course, you're very quick to decide because you don't have, all these structures above you that different layers of government to decide things. On the other extreme, you have a federal system, okay? And it would be the federation, okay, like in the US was the US government, to rule over the stuff, in most of the important key decisions in all the states of the US. But, Europe is not one thing nor the other. We're kind of in between, and that's bad. That's bad. I mean, there's a problem in European identity formation that has to do with, do we want to be a federation, or do you want to be, go back to increasing states and governments' ability to decide things unilaterally? And irrespectively on which side you stand, my view is that you need to pick a side, and Europe needs to pick a side. Otherwise, this schizophrenia at decision, especially in foreign policy. I mean, you saw what happened in Turkey, right? So that's a problem. Okay, so I guess thanks everyone for the questions. I hope that you enjoyed. I think I would leave it to Miguel to do the close-up.
Yeah, thank you very much, Pedro. I think it was fantastic, and thank you everyone who joined us